Welcome back to Investing Talk podcast.
Good to be here.
Today, we're taking a close look at EON Resources. They're an independent energy company focused on oil and gas exploration and production right here in the Permian Basin in the U.S.
That's right. We've waded through some recent analysis and reports on them.
We have, and we've tried to pull out the most important insights to understand, where they stand right now, the financials, their business strategy, the key risks, and, well, the potential upside.
The idea is really to distill what's critical from all that information. We want to help you cut through the noise and understand what's fundamentally happening with EON Resources and maybe what it could mean going forward.
So why focus on a name like EON Resources? Well, first off, they operate in the Permian. That's not just any region. It's one of the most active and, frankly, economic oil basins globally right now.
Just being there gives them certain potential advantages.
Exactly. But maybe more importantly, EON is going through some pretty significant changes, things that some analysts think could signal a potential turnaround. But these changes definitely come with notable risks, too.
It makes for a really interesting case study, doesn't it? Looking at the complexities smaller energy companies face.
It does. It shows how acquiring a key asset and really shifting operations can change a company's trajectory, for better or worse.
Definitely.
Absolutely. And look, if you find this discussion valuable, please take a moment to subscribe, maybe give us a like, leave a comment with your thoughts too.
And consider buying us a coffee to help support our work. We really appreciate that support.
We do. Okay, let's unpack who EON Resources is. This company used to be known as HNR Acquisition Corp.
Right.
They're what's called an upstream player. Basically, they find and produce crude oil and natural gas. And their main focus area is the Permian Basin, specifically in New Mexico.
And their most significant asset right now, the one getting a lot of attention, is a water flood project they picked up back in November 2023.
Can you explain water flooding a bit?
Sure. Think of it like this. After you've drilled wells and pumped out the easy oil, the pressure drops. A water flood involves injecting water into the formation to push more of the remaining oil towards the producing wells. It's a common secondary recovery technique to get more out of mature fields.
Got it. Giving the field a second life, essentially.
Kinda, yeah. And this project covers a pretty big area, about 13,700 continuous acres in the northwest shelf part of the Permian. It already had wells producing and wells for injecting water.
Okay. So their core business model, based on what we've read, seems to be about growing by acquiring properties like this one, properties with existing potential.
Right, existing production or upside.
And then trying to boost that production using techniques like water flooding, all with the goal of, increasing value for shareholders.
Precisely. It's about optimizing these acquired assets, making them work better.
Now, looking at their stock performance lately, it's shown, I'd say, moderate volatility, which isn't too surprising for a smaller energy name.
No, that's pretty typical. It's generally trended sideways more recently.
But year to date?
Year to date, it's actually done a bit better than some of its microcap peers. The thinking is this outperformance is largely tied to the optimism around buying that Permian asset and the financial improvements that followed.
So the stock price seems driven more by these company-specific operational updates and maybe just the general mood in the energy sector, not really any big, sudden disruptive news events for EON itself.
That seems right. For a company this size, the market's really watching how well they execute on that main asset.
Okay, here's where things get really interesting, I think. Their financial health, especially the Q1 2025 results. They reported revenue of $4.6 million.
Which is a pretty significant increase, up about $850,000 just from the previous quarter, Q4 2024.
And why the jump?
Well, mostly because Q1 was the first full quarter where they got the contribution from those newly acquired Permian assets. Q4 only had part of the quarter. And importantly, they also reported income from operations of $1.8 million in Q1.
And the reports also really highlighted some key cost reductions, specifically lease operating expenses, LOE. The day-to-day costs of running the wells came down quite a bit.
Yes, down to about $683,000 per month. Those cost controls are absolutely critical. They're a big reason the company is starting to move towards profitability.
Right, because after reporting losses in prior quarters, these operational improvements in Q1 actually led to positive net income.
That's a key shift, and the analysis we saw projects a really dramatic turnaround for their full-year earnings before tax, or EBT. They were looking at a negative EBT of over $500,000 back in 2022.
And the forecast for 2025?
The expectation is for a positive EBT of around $9 million for the full year 2025.
Wow, okay, a swing from a $500K loss to a $9 million profit projection in just a few years. That scale of turnaround is massive if they can hit it.
It is. The reports noted specific Q1 or Q2 EPS numbers weren't available yet, but that trend towards operational profitability is pretty clear.
Let's talk about their debt situation. That seems to be a major focus point in the analysis.
Definitely. As of mid-June, the numbers were roughly total liabilities, $71.35 million, total assets, $103.86 million, and total debt around $42.32 million.
Okay, so doing some quick math, that gives an implied debt-to-equity ratio somewhere around 1.31. The reports call this moderately high. What does that mean practically?
Well, for a smaller company like this, it means for every dollar of equity the owners have in the business, the company owes about $1.31 in debt. It's not, off the charts high, but it does mean they carry more financial risk than companies with lower debt.
Amplifies returns if things go well, but
That makes them more vulnerable if oil prices drop suddenly or they hit unexpected operational hurdles. Leverage cuts both ways.
the really key point here, the thing highlighted everywhere, is this major debt restructuring agreement.
Yes, this is pivotal. They've struck a deal with Pogo Royalty, and this deal is set to eliminate approximately $40 million in debt and obligations.
$40 million. Just wiped off the books. That seems transformative for a company their size.
It really is.
What are the terms? How are they doing that?
It involves EON making a $22 million cash payment and also issuing 3 million shares of their common stock to Pogo Royalty.
Okay, cash plus stock. And when is this supposed to happen?
It's expected to close very soon. This month, in fact, June 2025.
And management is obviously framing this as a huge step, improving balance sheet flexibility, cutting near-term financial risk.
Which seems fair. I mean, even after this deal, their absolute debt level will probably still be a bit elevated compared to the really big industry players. But removing $40 million like this, it definitely puts them on a much healthier trajectory, gives them crucial breathing room.
What about free cash flow? Did the reports mention specific FCF figures?
No explicit numbers were provided, but given those cost reductions we talked about and the improved operating income starting in Q1, the analysis suggests that positive free cash flow trends likely started emerging late last fiscal year and are continuing into fiscal 25.
Makes sense.
Yeah.
And similarly for return on equity, or ROE.
Same story. No specific ROE number given, but it's definitely expected to trend upward now that they're hitting positive net income. Just for context, profitable upstream energy companies often see ROE somewhere in the mid-teens. So that gives you a benchmark to think about once EON's ROE becomes more established and trackable.
Right, ROE being a measure of how much profit they make with shareholders' money.
Exactly.
Okay, let's shift gears a bit. Let's talk about their business strategy and how they fit into the whole competitive landscape. What gives EON Resources an edge, according to the analysis?
Well, one key factor is simply where they are. Their strategic position within the Permian Basin.
Location, location, location.
Kind of. Being in a super basin like the Permian means access to existing infrastructure, pipelines, processing plants. It means a skilled workforce nearby. And it means being part of ongoing tech advancements specific to that area. All that can potentially lower operating costs and give advantages compared to companies trying to work in less developed basins.
And beyond just location, they have specific identified opportunities, don't they?
They do. The reports specifically mentioned 50 well locations they've identified targeting the San Andres Formation.
The San Andres, that's a specific layer underground.
Exactly, a geological layer known for holding oil. So, these 50 locations are spots where they believe they can drill new horizontal wells to tap into that formation effectively. And the potential resource estimated from just these identified locations is around 20 million barrels of incremental production.
20 million potential barrels.
Yeah.
That's a significant number for a company this size, coming from identified spots.
It is. It provides a clear growth path, assuming execution.
How are they handling the risk of oil price swings? Because that's always a big one in this industry.
They're using hedging, basically locking in future prices for some of their production. The reports say they've hedged about 70% of their expected oil production right through the end of fiscal year 2025.
At what price level?
At or above $70 per barrel. So that provides a pretty solid floor for a good chunk of the revenue, protecting them somewhat if prices dip below that. Of course, the other 30% is still exposed to market prices.
Right. And plus, we talked about those cost structure improvements helping their competitiveness.
For sure. Lowering their operating costs makes each barrel they produce more profitable. So, putting it together, their competitive edge seems to come mainly from having a good asset base in a prime location and really focusing on improving their operational execution on that asset. It doesn't seem to be about some unique patented technology they own.
More about blocking and tackling, executing well in a good spot.
That seems to be the story.
So given all that, where do they sit in the market? Are they a leader? A niche player?
Definitely positioned more as a challenger. I'd say they aren't a market leader in terms of overall scale. But with the recent financial improvements and those identified growth plans, they are showing some real momentum within their specific niche, which is optimizing these acquired, mature assets using methods like water flooding.
Okay. What about the broader industry trends? What's helping them, and what are the big risks they face?
Yeah. Well, growth drivers for EON specifically include having those, high quality assets in the Permian. The general recovery and relative stability we've seen in oil prices helps too. And of course, their own success in gaining operational efficiencies.
Any specific examples on the efficiency front?
Actually, yes. One report mentioned they've started investing in AI-driven operational efficiencies. That's a trend across the sector using data analytics to try and optimize how fields perform, things like managing the water flood better or predicting maintenance needs.
Interesting. Using AI to squeeze more out.
Ugh.
And the risks.
Okay. On the risk side, there's always potential regulatory uncertainty, especially around environmental rules, emissions that can impact operating costs down the line.
Standard industry risk, really.
Pretty much. Then there's the fundamental risk of commodity price swings affecting that unhedged portion of their production. But a major risk that was really highlighted in the analysis is the execution risk on their new drilling program, the one targeting those 50 San Andres locations.
Right. Tell us more about those expansion plans and why execution is seen as such a key risk.
So the plan is to get permits for 12 new wells by late 2025 or maybe early 2026, with the actual drilling scheduled to kick off in the first quarter of 2026.
Okay, that's a concrete timeline.
It is. But the crucial point the sources emphasize is that these plans, especially scaling up to tackle all 50 locations eventually, are highly dependent on securing partner capital and engagement.
Partners meaning other companies to share the cost and risk.
Exactly. They need others to come in alongside them. Now, they do have a letter of intent, an LOI, with a group called In-Stream Capital.
An LOI, so not a done deal, but a step.
Correct. It's an indication of interest. This LOI is for up to $52.8 million in what's called volumetric funding. This type of funding is specifically intended to support future drilling programs.
Volumetric funding, how does that work?
It's a mechanism where the capital provider in-stream, in this case, basically gets paid back based on a certain volume of oil produced from the wells they fund. So their return is directly tied to the success of the drilling. It's different from a standard bank loan.
Okay, so the LOI suggests the money might be there, potentially. But that's not the same as having the partnerships fully locked in and the drilling rigs lined up for all 50 wells, is it?
Not quite. That's the execution risk. Securing the actual operating partners, moving from that LOI to firm funding commitments, and then successfully drilling and completing those wells on time and on budget. That's the major hurdle they still need to clear to realize the full potential of that San Andres program. The LOI is promising for funding availability, but the actual doing it still needs to happen.
That clarifies the dependency nicely. How does EON stack up against some peers? The reports mention companies like Ring Energy and Evolution Petroleum.
Yeah, those are useful comparisons. They're also smaller to mid-size U.S. onshore producers. Ring Energy operates in similar areas in Texas, but is generally a larger company overall.
Bigger scale.
Right. And Evolution Petroleum is interesting because they're more diversified. They operate in multiple mature basins across the U.S., not just focused on one area like EON currently is. EON Resources is definitely smaller by market cap than both of those.
So what does that difference in scale and focus mean for an investor looking at them?
Well, it means EON potentially offers higher percentage of growth potential in the near term, and it's a big if, they successfully execute their drilling plans and ramp up production from their current base. But it also means they carry higher relative risks.
Because of the smaller size, the leverage we talked about.
Exactly. And the concentration risk being so reliant on that one main Permian property. Ring Energy might offer a bit more scale and stability. Evolution Petroleum offers diversification across different basins. EON is kind of earlier in its potential turnaround story compared to those more established peers.
Okay, let's try to bring this all together then. The risks, the sentiment around the company, and the general outlook. Can you summarize the absolute key risks that jumped out from the analysis?
Sure. Top of the list is probably still having that moderately high leverage profile, even after the upcoming debt reduction gets done. It's better, but still something to watch compared to larger competitors.
Then the concentration.
Yes, significant concentration risk. Being so heavily reliant on the success of that single core Permian waterflood asset, if something unexpected happens there, it impacts the whole company disproportionately. They also have a relatively limited operating history as this integrated entity since acquiring that key asset.
And the big one we just discussed.
The major execution risk on those new drilling projects planned for 2026. The timing, the cost, and especially the dependency on securing those external partners and firming up the funding beyond the LOI, that's critical.
Plus the usual suspects.
Right. Oil price volatility for their unhedged barrels remains a factor. Potential for new energy regulations impacting costs is always there. And the analysis did note that while profitability is improving, they're still likely navigating some legacy costs from before the acquisition and the turnaround efforts really kicked in.
Okay, shifting to market sentiment. What's the general feeling out there about EON Resources right now?
Based on recent news coverage and analysis, it seems to be cautious optimism, especially following that positive Q1 earnings report.
Cautious optimism, meaning?
Meaning analysts acknowledge the real operational improvements, and they definitely see the significance of that big debt deal. But they're also clearly emphasizing the need to monitor how the company manages its remaining debt load, and crucially, how well they execute on those expansion plans we keep talking about.
So, improvements noted, but show me mode on the future steps.
Pretty much. And what about outside of formal analyst reports? Any sense of retail or social media buzz?
There seems to be moderate retail investor interest. Looking at social media chatter, the sentiment there is kind of mixed, but maybe leaning slightly bullish, driven mostly by those recent financial improvements.
But any concerns voiced there?
Yes, there is some noted concern about potential dilution. The impact of those 3 million new shares being issued as part of the debt restructuring deal. And there's also some speculative chatter floating around about potential joint ventures, specifically for that San Andres drilling program. But the sources are clear that this is unconfirmed right now. Just talk. Okay, so overall, no major analyst downgrades or overwhelmingly negative headlines recently.
Not that were highlighted, no. Sentiment seems to be hovering around neutral to positive, but it feels very contingent on the successful closing of these key near-term events, especially that debt deal finishing up this month, and then seeing continued proof of solid operational execution in the coming quarters.
Looking ahead then, what are the potential catalysts? What could move the stock significantly, one way or the other?
Well, the next quarterly earnings report will be a big one. That's expected probably August or September. It'll be the next major data point showing whether those Q1 operational improvements were sustainable.
Continued positive momentum would be a catalyst.
Right. Also, further down the line, maybe potential for future acquisitions could be a catalyst, if done prudently. Although management seems pretty focused on optimizing the current asset first.
Yeah, you mentioned their stated focus.
That seems key. They've apparently said they want to fully optimize the performance of their current assets before chasing really aggressive, large-scale expansion beyond the San Andres drilling that's already planned. That suggests a more measured, step-by-step approach, perhaps.
Makes sense. And the main risks that could derail the positive outlook.
A significant, sustained decline in oil prices would obviously hurt, even with the hedging they have in place. And as always in this sector, unexpected, unfavorable regulatory changes could create headwinds or increase costs.
Okay, let's try to pull together a summary for this analysis of EON Resources. What are the main drivers that have generated this cautious optimism and led to the recent positive trends we've discussed?
I think the number one driver is that announced agreement to eliminate roughly $40 million in debt and obligations via the Pogo royalty deal. That's expected to close very soon, and it's a major de-risking event for the balance sheet.
Huge. What else?
Then you have the tangible improvements we saw in the Q1 numbers, better revenues, positive operating income. That shows the potential of the acquired asset. Plus, they have clear, identified plans for future growth with those 50 potential well locations in the San Andreas. And evidence of cost controls, like the hedging program, adds to the story.
So positive momentum operationally and a big step on the debt front. What's tempering that upside potential? What are the key factors keeping the sentiment cautious?
It really comes back to those ongoing execution risks. They're significant, especially related to the timeline and the heavy dependency on getting external partners lined up and funding finalized for that large-scale drilling program starting in 2026.
Show me aspect.
Exactly. There's also just a continued need for them to consistently demonstrate that the improved profitability metrics are sustainable over multiple quarters, not just a one-off. And the remaining debt level, even post-deal, and the asset concentration risk are still factors to keep in mind.
So given that balance, the improving fundamentals versus the risks, what was the summary recommendation from the source material we looked at?
The summary recommendation found in the reports was essentially a hold.
A hold. And the reasoning behind that, why not buy or sell?
The rationale provided was basically this. EON Resources is showing genuinely improving fundamentals. That's driven by the key asset acquisition and the operational efficiencies they're finding. And it definitely benefits from being located in a top-tier basin like the Permian. However, the analysis concludes it still carries what they consider above-average risks.
Primarily due to?
Primarily due to that moderately high leverage, even after the reduction and the significant concentration of its business on that one core property, plus the execution risk on the future plans.
So, for you, the listener, trying to make sense of this, what's the suggested approach?
The report strongly suggests that before you consider taking new positions or maybe upgrading your view beyond just a hold status, you should really monitor the upcoming earnings reports very closely.
What should you be looking for?
You'll want to see clear, consistent evidence that those operational gains and the cost controls we saw in Q1 aren't just a one-quarter blip. You want confirmation that they are sustainable and are actually translating into consistent free cash flow generation over time. Proof of execution, basically.
Okay, so wrapping up, you've now got, hopefully, a clearer picture of EON on resources. It's a story of balancing those recent financial wins and the pretty exciting future growth potential from those identified drilling locations.
Against some significant hurdles. The remaining leverage, the concentration risk in that one main asset, and especially those execution challenges tied to needing partners for their big expansion plans.
Is definitely a company with a clear path forward outlined on paper.
But also several really crucial future milestones that they absolutely need to navigate successfully.
Right. We've seen these ambitious plans for the horizontal drilling starting next year. That San Andreas program holds significant potential for boosting production. But, as we've stressed, it seems to hinge almost entirely on securing those partners and firming up the funding beyond just the LOI.
That dependency is key.
So given that concentration risk in their asset base, the provocative thought for you might be this. How comfortable are you investing in a company where the success of its potential turnaround seems so heavily reliant on executing one single large future initiative that depends so much on external partners coming to the table?
That partnership and execution piece, that really does feel like the central risk factor that could determine the long-term outcome here.
A lot to chew on there. Thanks for tuning into this discussion.